Good morning.
Morning.
So in the morning, we were discussing on how to manage account or the inventory management. Okay. So what was remaining is how to discuss all of the how we uh, analyze a case where the supplier is giving you discounts, and this discount is based on the number of days. Okay. So I want us now we do part one. Okay, take 1 minute to refresh yourself on the question. Then we discuss part one because we'll discuss part two. We discuss part one where the discount being offered is offered based on the when you pay. Okay, it's more or less a case of payables management. Okay, so this part one is more of payables management. Okay, so go through it. We discuss together. Okay, presuppose that you have gone through the question. Okay, let's attempt to do it together. Okay, so in this question, okay, let me take a screenshot of the question. Okay, so the supplier has offered either a discount of 0.5% in full within 30 days, okay, or 3.6%. So here, I think we discussed the discount that is based on quantity. So concern here today, right now, is to a case where the discount is based on when you pay. So supplier is telling the company, the supplier is informing the company that you're going to give you a 0.5 discount if you pay within that day. So here, payment must be within 30 days. Okay, payment must be within 30 days. So the question is, how many days does the company currently take? Okay, so the discount to be offered is 0.5% discount. So currently, how many days does this company take to pay the supplier? Okay, let's assume that, hey, let's pay the supplier. Now, let's take the discount that has been offered to us by supplier, because therefore the total discount to be received, okay, if the company was to take the offer, to discount received will be equal to 0.5% discounts, okay, we multiply by the total purchase that the company makes from the supplier within an year, which was equal to 120,000 units, okay, and paying a price of 7.5. If in a year, that's the amount of discounts that we shall be receiving if the company was to take the offer from the supplier. How much is it?
For 50,000.
For 50,000. No, don't forget it's 0.5%. 4,500.
4,500.
Yes, we get 4,500. Okay, 4,500. Therefore, the discount the company will see. Don't forget, this is a benefit to the company. Okay, that in case the company was to, if this discount offer was to be processed, rather, the company was to take the offer from supplier, then they'll be getting a benefit of 4,500. However, there's a catch. The catch is that you must pay within that days. Okay, so the question was asking that currently, how long do you pay? Do you take to pay the supplier? Okay, we need to work that. We need to work that. Okay. Therefore, the current payable days, okay, so for payables days currently, okay, is equal to the number of days in a year. We'll be trying to use this 365. We multiply, because payable, the amount that we owe the supplier, we divide by the purchase minimum credit, okay, credit purchases, okay, and which may mean currently, how long do we take to the supplier? The current terms are payment in full within 90 days. Okay, we can see that in the first paragraph there. Okay, the currently the payment are in full within 9 days. So we assume the company. So here is an assumption. We assume the company actually stick to the agreement they have with supplier. They pay in the 90. Okay. So you have the days. So what we can do is to get the payable. Okay. Therefore, at any point in time, how much does the company owe the supplier? Okay. So we get for the payable. They have the payable investment is equal to 90 days out of 365. We multiply by the purchase whether to make on credit during that year, which is equal to payable investment. Rather, the purchase on credit is total purchase made was equal to 110,000. Okay, times 7.5. That was the total purchase. Okay, so all the purchases that the company is making are paid or are on credit. Okay, so they're all credit purchases. Therefore, at any point in time, how much does the company owes the supplier currently? Okay, this you can see this is the current position. How much? 2.
$221,918.
918.
Yeah,
Okay.
918.
So what that means is that at any point in time, okay, the company owes supplier 221,918, or within the year, the average amount the company is owing, okay, is 221,918. Okay, that's the amount the company owes supplier at any point in time. Don't forget, in total, okay, the amount the company owes supplier, okay, or has been owing the supplier through the year is 120,000 times 7.5. But our main concern together, what's the average? Okay, if you have to go and do an audit in court of the payable at any point in time, okay, the average payable will be equal to 221,918. Okay. Now, what if the company accepts the proposal? Okay. If you accept the proposal, you must pay within that days. I think you did mention that you must pay within that days where to get the discount. Okay. So therefore, as per the proposal, what will be the amount the company will be owing the supplier? Be equal to 30 out of this 5. We multiply 127.5. We got what? 127.5, which is called the purchases. It will remain the same. It was 9 something. Can't remember. 900. So purchases is the same.
900, yeah.
900. Okay, great. Okay, because of the purchases. Therefore, if the company was to accept the supply was to accept, okay, the supplier's policy proposal, in short, okay, then there will be the payable investment will be 30 divided by this 5 times 900,000 to give us how much? 70.
73,973.
73, 973. Okay. If the company was to accept the proposal from supplier, then the amount they will be owing the supplier at any point in time is 73, 973. Is it something good or something bad? That's something in quote something bad. In the sense that okay, supplier used to give you money, 212,000, but if you accept the proposal, the amount they'll be giving you in quote is 23,000. What you mean, therefore, there's a decrease in the amount they're going to be giving you. Okay, therefore, the decrease, therefore, the decrease in the payable will be equal to 140 if the difference 221 minus 23,000. The US 140.
147,945.
945. Well, you mean therefore that in case you accept the proposal from supplier, then the amount they will be giving you, okay, has decreased by 147. Now, what does that mean? It means as a company, since you want to remain where you are, then you need to get someone else to give you this money. Okay, supplier used to give you money, 221 before. Now they're going to give you 23. So you must look for where do I look for? We need to look for money, in short. Okay. You need to go outside of ourselves and try to look, is there another person who is going to be financing us? Okay. Don't forget here, the supplier, they used to give you goods worth 221. After they give you goods worth 73. So you have a deficiency of 147. So you have to go and look for money. Now, who is going to finance you, as per the question? Or who is going to give this 147? As per the question, it's there, the question. Well, someone else must give you that money.
Short-term finance.
Yes, it can be from either from a bank, most likely be from bank, okay, through short-term borrowing, okay. It's going to go to the bank, ask the bank, hey, my payables has decreased, okay, I need 147,000 to finance my working capital, okay. Does the bank charge you money for borrowing? Is there any interest the bank charges you for borrowing money from them?
Yes, 4.5%.
4.5%. Now, don't forget, supplier, they don't charge anything. They don't charge any interest on you, okay? Because it's simply they're your suppliers, so they don't charge any interest. However, now you're going to borrow from the bank is going to be charging you fee for that, okay, an interest. So this is an incremental cost, okay. Therefore, interest on borrowing, therefore, okay, interest on the short-term loan you've taken or the short-term borrowing you've taken it will be equal to 4.5% times the amount you borrowed from the bank, which is 147,945. Therefore, how much interest therefore do you pay to the bank?
6,658.
58. Okay, that's the amount to be paying to the bank. Okay, for the amount you have, for the 147,000 you have borrowed from them. Okay, look, this is a cost. Now we compare the benefit was a cost. It's a cost. The benefit you received was a discount, and the discount you got was 4,500. Now you compare the discount versus the cost. As you can see, the cost is greater. Okay, therefore the net cost will be equal to the cost 658 minus the benefit, which was equal to 4,500. This gives therefore 2158. Therefore, is this a good proposal? No, because the benefits are lower than the cost. Okay, therefore this is not a good proposal. Okay, don't therefore accept it. Okay, therefore the company should not accept the supplier discounts proposal, the supplier's discount proposal or discount offer. Okay, since it yields or since it will result to a net cost, it will result to an annual net cost of 2158 per annum. Actually, and it's an annual. Okay, And that's it. That's what you're meant to do, to have done in that particular question. Okay, you're comparing benefits versus cost. Okay, comparing benefit versus cost. Clear? Question?
Sir, could you repeat why you use the payables days?
Where I use the payable dates.
Yeah.
Do I get your question really clearly? Okay, where exactly? Because
At the start.
at the start. Okay. Let me just try because I can't remember. Okay, so don't forget our main idea is determine, okay, how much do we currently, how much does the suppliers of we owe supplier money, but we owe them money in terms of buying. We bought a good from them on credit. Okay, before the amount they used to give us. Okay, they used to finance us, of course, in form of good was 221. 221. What is it? 221 800. 221. It was 221, I guess. 221 918. Okay, that's the amount that we as a company, okay, we used to get from our supplier, but in form of goods on credit. If we accept the proposal, okay, from supplier, how much are you going to, how much worth of good are you going to be having from them? 73 973. Which means therefore the amount of goods they're given to you on credit have decreased from 221 to 73. What's the decrease? 945. Now the question is therefore, okay, who is going to, don't forget, as a company, you have to make the sale. Okay, we assume that the company status remain the same. Okay, which means therefore you have to go, you have to look for someone else who is going or who will be financing you money. Okay, because supplier is not giving you the amount of goods have decreased from 221 to 73. Therefore, we have a deficiency in terms of finance equal to the difference, which is in this case 147 945. Okay. Now, who is going to finance you? You have to go, for example, as shareholders. By this case, you're going to be asking the bank to finance you. To give you how much? 147 945. The bank is going to charge you a fee of how much? 4.5%. Okay. But times the amount you have borrowed, which in this case is a decrease, which is 147 945. Therefore, every year you pay in an interest cost of 658. Clear?
Yeah, but I don't get why you didn't deduct the discount from 900,000.
Okay, I get. Oh, so why didn't deduct the discount here on this point?
Yeah.
Okay. Now, don't forget here we are following accounting. Okay, this is the use of accounting. When it comes to example, when you prepare the accounts of the company, okay, how do you report purchases? Is it net of discount, or is it full without the discount being deducted? Even sales, how do you recognize discounts? Do you recognize them as sales less discount or purchase minus discount received? How do you recognize the discounts in accounting, even when they normally prepare their financial statements?
Purchases minus discount received.
When you prepare the income statement, how do you prepare the purchases? Is it net, or is it the gross or the net value?
Net value.
Are you sure?
For the purchases, right?
Even for sales, by the way, the same principle follow for both of them.
Okay, so you for purchases you write the gross amount and then you deduct discount received as income, other income.
Yes, don't forget the discount you received is other income. We don't deduct. So the purchases is gross value. What appears on the financial statement is a gross, not a net. Okay. The income received become part and parcel of other incomes. I hope you can remember how you prepare account statement. The same thing we are using here. We are reporting it as a gross, not as net. Okay.
Net.
We don't net them off. Even for the sale, you don't net off the discount. Okay, discount that you give is part of expenses. Okay, so we don't deduct it from the sales. Okay, that's what I've done even here.
Okay.
Okay, yeah, we don't deduct because we just follow the simple accounting rules. Okay, that's what I've just done even here.
Okay.
Okay, any question?
Sir,
Yes, sure.
I have a question. Okay, so so payables are basically the amount that we owe to the suppliers, right?
At a point in time, yes.
Yeah, so in this case, um in when it comes to the 90 days, we're
Mm-hmm.
paying 221, right?
Not we are paying. Don't forget the amount to be paying by the end of the year. The amount to be paid is 900,000. That's the amount to be paying. Okay,
Okay.
221,000 is the amount you owe the supplier at any point in time. Okay, if you're through or call an audit, let me tell you, not in court, an audit. Okay, you go and ask how much do you owe the supplier A. On average, the amount to be owing them at any point in time is 221,000. But now this is not the amount you owe them. Don't forget. This is just an average value. This is just an average value. Okay.
Okay, but see, for
Mm.
30 days, then the value it drops, like it's 73.
Yes, 73. Now, in that this
Yeah.
time, at any point in time, okay, the amount you'll be owing the supplier is equal to 73,000. It drops from 221 to 73. Okay, continue.
So isn't that like good?
Okay. Don't forget here,
Because
let me give an example. So here are the two alternatives. Okay, either you go to get financed by a bank or get financed by a supplier. Okay, that's those two alternatives. Okay, the amount you get to receive from the supplier, they don't charge you any interest on the amount on the money, isn't it?
yeah,
They don't charge you any interest on the amount that they've given you. Okay. However, if you don't take supplier, who else is going to finance you?
like a bank or
Like
something.
the bank. Okay. The case
Yeah.
the bank is going to take over. Now the problem with the bank financing you, okay, in quote problem, is that you'll be paying interest to the bank, which you never used to pay before.
Yeah.
The issue here is that someone must finance you working capital. It's like you don't have money. So someone else
Yeah.
must come and finance the company. So if you don't take supplier money, then where do you take the money? Where do you get the money from? From the bank. Supplier, this will give you money for free. Is it free in quote? Okay. The bank will have to take interest. So is that something good or something bad?
That's bad because like it's
That's
an
bad.
added cost.
Yes, another cause. That's the case here. That's what you're doing here. That here, the supplier used to give you money, okay, to the tune of 221,000. Here, the gain used to give you only 24,000, which is bad in quotes, okay. And to the extent that you'll be paying more interest because you have to look for someone else to take over where the supplier have in quote decreased or given you less money. Can you see that point?
Okay, so when you say that the supplier is giving you money, what do you mean?
It's giving you money, but in form of goods. I don't know if I can say that from that angle. They're giving you money, they're financing your operations, but they're not giving you actual
Mhm.
money. They're giving you goods worth on credit. Okay. So it's like
Okay.
they're giving you money because either way, if the bank was to give you actual money, where do you take that money? To finance, to buy your raw material, to buy your inventory, is it?
Yeah.
So they're not the supplier, since they're the one who manufactures the raw material, they're making the inventory, they're not going to give you cash. Okay. However, they're giving you their money, but in form of goods.
Okay. So
Yeah.
in this case, the
Mhm.
payables is basically the amount that suppliers are giving us.
Yes, on credits
Yeah.
at any point in
On,
time.
okay. Okay. Fine.
Yes,
Okay.
yes. Okay. Clear? Any other question? Okay, okay. That's good in case you understood. So don't forget here, we are still doing a comparison of the benefit, okay, versus the cost of the policy. Okay, there is the cost of the policy, and therefore, can see the cost are greater than the benefit. And of course, therefore, we ought to reject the proposal. Okay, the proposal on the 0.5% discount offer. Any question? Okay, no question. Now that's on the inventory. Okay, I think we have discussed more than enough question. Okay, I don't think that there's any other part which on inventory which we have not taken into account. Let me put the question bank again. No, I would want to do a question. You to do a question, and I think we shall do at the end of the class. Okay. So let me see if I can be able to. Okay, just to evaluate your concept of understanding the concept of inventory management. So let me just try. I guess it's quite easy, I guess. Okay. Okay. So I'll ask you to do one question. Not now. Let me just do a question from part A, part B of the exam. This one that I saw. Before we start by discussing how to manage account receivable. That is. Okay, in my question bank, it's page 74, page 75. Okay, a company called Krag Company. Page 74, page 75. Okay, a company called Krag Company. Okay, it's just like what we actually discussed. Okay, so go through it. We discuss together. Actually, first make the attempt. Let me see how far I can go. So make the attempt. Receivable management of account receivable. And just like by the payables, one you've just discussed right now on payables management, the same principles shall be following or using when it comes to discussion regarding how to manage the account receivable. Okay, where in the account receivable, we want to determine, for example, how much of our sales, okay, should we be extending to our customers on credit, okay? How much of the sales, okay, should we be extending to a customer on credit, okay? How much of, how many days, for example, should we be giving to a customer? Should we give them 10 days? Should we give them 30 days? How much discount should we give to a customer, okay? So there's a number of things that as a company you must decide on, okay, with regard to sales that you make on credit, okay? If a customer don't pay on time, what shall we do? Okay, do we take them to court? Okay, do we ask the court to liquidate the company? Okay, we are Tuskys. Okay, you are suppliers of Tuskys. What do you do? Because you supplied money to Tuskys. They are your customers. Okay, now what do you do with regard to the amount that the Tuskys owes you? Okay, so that is what shall be discussing when it comes to management of account receivable, okay, with more concern towards the financial, okay, the quantifiable benefits and the quantifiable costs, okay, like just like the case we have done with the payables management, that example we did there, okay. But first of all, as a company, you must have a policy that defines, okay, the rules and regulations in quote, okay, of how you deal with your customer, okay. We as company A, we only sell on cash, okay. So that's in scale is a company policy, okay. So you must define what to be the policies, what will be the terms and conditions that you deal with your customer, okay. So account receivable, okay, is in okay, of course, account receivable is the amount that the customers owes you on credit, okay. So you made a sale to them, or you made a sale on goods, okay, to them that was on credit, okay, which implies therefore those sales that you made to them, okay, became part and parcel of account receivable, okay, sales made on credit, which implies therefore if you are a retailer, okay, as an example, in case there's market, okay, you sell on cash, which implies therefore the amount of account receivable you have in your book is zero. Therefore, if you sell on cash, therefore, you have zero account receivable investment. Which, of course, if you can make the profit, then why would you want to make sale on credit? Okay. So don't forget, in most of the time, okay, the company will be selling on credit. Okay. In case where maybe the only way for them to make sales is by selling on credit. Okay, because who would want to sell on credit if they can able to make the same profit without the need for them to sell on credit? No one. as I mentioned, don't forget, working capital can require financing. Okay, and the sales, the goods you are selling on credit to your customer means that someone else must have financed you. Okay, so that you can be able to make sales on credit. Okay, so it costs money definitely. Okay, anyway. So what are some of the factors that influence the amount of receivable we have, the amount of investing receivable we have as a company between 1 year to the next year? Okay, one of them, of course, definitely is the economic condition. What are the market conditions? How is the market like? Okay, is the market performing well? Okay, we are in times of COVID. Okay, so do you sell on credit? Do you sell on cash? You have to be quite careful in terms of management of your cash position. Definitely. Okay. So generally, for most firms, okay, they would want to adopt, okay, a case where it's purely cash system, okay, because even you to obtain finance with the bank is not easy, okay. So the credit to get someone to finance your working capital is not easy. So why would you want to extend to your customer, okay, goods on credit, and no one is going to finance your working capital, okay? So it's a balance, okay. So generally, therefore, if the cost of credit is quite high, then quite likely are you going to want to sell on credit, okay? Because no one is financing your working capital. So why would you want to finance your customer, in short? Anyway, yeah, the cost of products, okay, of course, in comparison to the competition, for example, okay. So if, for example, your competition, they offer the same quality, but they charge less, then of course you're going to have less sales, and that deploy less working capital, less account receivable, okay, based on your competition. So in case you do offer good quality products, okay, of course the customer would, if you assume they're rational, of course they go with where they're able to obtain higher quality products, okay. So the person who's going to be selling at the same price, maybe at a better quality, then of course you make it able to make more sales, okay, which implies therefore you will have a case where you do have a lot of sales, that means therefore you do, or you're able to have more profit, okay, for the same you're able to more profit because the number of sales are high. And if as a company you do sell both on cash or on credit, if the sales figure, if the amount of sales are increasing, that implies therefore more cash sales and more credit sales, and by by implication, therefore you'll be having more or higher value for account receivable. The other factor is, of course, the company credit policy. What is your policy? What is the company internal regulations that governs, okay, how the company deals with the customer, okay? Some companies say that, hey, our policy is that we may not make a lot of sales. However, let's not sell on credit, okay? We as a company are comfortable, okay? We as this private company, we are comfortable to make, I don't know, fewer sales. However, we are sure that we are not going to be running into problems with our customer, because once we make sale to a customer, in quote, that is it, okay? Of course, we do offer, for example, after sales, but either way, as a company, as we don't sell on credit, that's a company policy, okay? The company has adopted, okay, which of course therefore will be influencing the amount the company will be investing will be investing towards their customer for the goods they have bought on credit, okay. Okay, so discuss these factors alone, okay, but more in detail, okay. Just like the case of payables investment, okay, we say that at the end it's a trade-off, okay. You have to consider, okay, how much profit, for example, okay, do we make as a company from this particular sale, okay? How much risk does it come with, okay? Don't forget, you have to quantify, for example, the chance that maybe you make a sale, you intend to make profit, but in reality, that customer end up becoming a bad debtor. Okay, it can happen. So definitely. So you have to be able to strike a balance. Okay, how much profit does this particular how much does this sale, okay, make for us as a company? How much profit are you going to make from it? Okay, and how much risk does this particular sale come with? Okay, in terms of, for example, financing costs that we as a company have to pay to the provider of capital. Okay, the risk that they become a bad debtor. Okay, so you have to quantify all these things. Okay, you have to quantify all these things. Okay, therefore, as a company, therefore, you have to make a trade-off, okay? Because in case you want to increase your sales, maybe, okay, if the market is quite competitive, okay, then of course you may have to be offering your customer goods on credit. But either way, okay, you have to quantify. You don't just give credit because your neighbor is doing that, because you are competitor doing that. Okay, you must do your math, okay? You must quantify the benefits to be earned. You must quantify the financial cost that will come with you adopting that particular policy. As I mentioned, don't forget when it comes to the credit policy, generally, okay, the company must establish a policy. Just highlight. The company must establish a credit policy, okay, for the credit terms we give to the customer, okay. And the optimum will come in if we are able to quantify the amount of profit you'll be earning from, for example, more sales you're making, but at the same time, the cost of credit that you're going to be allowing, okay. So you have to be able to strike a balance between those two things, okay. The profit you're making from the extra sale you make, but at the same time, you quantify the cost that comes with it, okay. And if you're able to maximize the profit as opposed to and minimize the cost, then of course the better off. Okay, if you have more financial benefit than the financial cost, the better off for the company definitely. Okay, because you're there. Okay, we are assuming that you are a commercial enterprise. Don't forget. Okay, so you are there to make money for the shareholders. Okay, you're there to maximize the wealth of the shareholder definitely. Okay, that means therefore, the more profit you make as opposed to the cost, the better off for you as a company. Okay. So there are two policies that you can follow, okay, which is we should discuss it alone, okay. There are two policies you can follow. One is called a lenient policy, okay. A lenient policy, okay, as you may guess from the term. Now the company is not going to be strict with the customer, which implies therefore, if the competition is giving the customer, let's say, that days, okay, you as a company give your customer 45 days, okay. So you give better terms, okay, better terms of credit, okay, better terms of trade, okay, to your customer, okay. You are much in quote better. You have better relationship, okay, in that way, okay, when compared to the competition, okay. That's a lenient policy, okay. If other customers, if the competition is asking for customer to be at least maybe, okay, have a bank balance of 10 million, okay, you as bank A, you only ask the customer to present themselves, okay, with their ID, okay, your equity bank, okay, compared to Barclays, okay. So what are your policy regarding when someone has to open a new account, okay? Do you follow very strict terms, okay? Do you follow some lenient terms, okay? So how do you deal with the customer, okay? We are making a simple comparison with the market to say whether your policy is lenient or your policy is stringent, okay? So there are two policies you can follow. You have lenient policy and you have a stringent policy. A stringent policy, okay? Let me let in a better way. We call a stringent policy. Okay, don't forget both policy have their own cost. They have their own cost implication. Okay, so the idea is that okay, you whatever policy you follow, okay, whether a lenient policy or a stringent policy, okay, we are going to be strict to the customer in terms of the condition they must achieve first, for example, before you can sell on credit. Okay, either way, they have their own benefit both policies. Okay. But of course, you take the one that is going to be maximizing, okay, your benefits, okay, your net benefits as a company. Clear? Okay. When it comes to establishing the policy,
Sir,
sure.
could you repeat?
So,
Could you repeat, please?
because as I mentioned, either those two policies, either stringent policy, either stringent policy or it's either a lenient policy or a stringent policy, okay, it does not matter which you can follow either of the two policy, okay. The idea is that both of them have their own costs, both have their own financial benefits, okay. So the idea is that as a company, whatever policy you can be adopting ought to be maximizing the net benefit. If, for example, as we give this just to it for the sake of our understanding, if, for example, the net benefit you receive from the lenient policy is, let's say, $1,000 per annum, if you adopt the stringent policy, which of course you mean therefore you're going to be strict to your customer, the net benefit to be received is, for example, equal to $4,000. Then of course you go with the stringent policy. Okay, you may be strict with your customer, but in terms of financial implication, there's more savings here. There's more benefits to be received in case you follow this policy. Okay, as opposed to a case where you're going to be lenient with your customer. Okay, so it can go either way. Okay, so it's not that the case is told that one policy is better than the other. No. Okay, it's about your company in quote, sit down, do the math. Okay, quantify the financial benefit, quantify the financial cost that will come in case you adopt either of the policy. Then of course, therefore, you adopt the one that maximizes the benefit, the net benefit to be received. Okay. Okay, and that was clear. That was Sakira.
Yes.
Okay.
Thank you.
Then when it comes to the credit policy, okay, I think I mentioned this already. Don't forget you have to take into account a number of things, okay, when it comes to giving goods on credit. One of them, of course, is the demand, okay. How is the demand of your product, okay? because in most of the time, okay, even as a company, you know that your commodity is of high demand, okay, the market wants your commodity, then unlikely you're going to be offering it on credit, okay, because you know the market wants it. Okay, don't forget, as I mentioned, the main reason why the company offers good on credit is because they want to make sales. But in case like your product is assured of sale, okay, then quite unlikely you're going to be offering goods on credit. Okay, quite unlikely you'll be offering goods on credit. Okay, so the demand of product will be influencing. Okay, how you deal with your customer, definitely. Okay, how you deal with your customer. Okay, it's a case of which is this example. Is the KPLC, okay? The case of the KPLC, okay? It's a monopoly, okay? So, any other, maybe that's not a very good example, but either way, okay? In most cases, in case you are a monopoly, okay? So the market is like is assured, okay? In most of the time, the monopoly, they deal very unfairly towards their customer. They have actually one of the poorest customer service, okay, because either way you as a customer, okay, you have no any alternative, okay, you have to stick with the company because where else do you want to go, okay, so therefore you may have a case where, okay, the company, the demand of the product, okay, may therefore end up influencing, okay, influencing therefore how they deal the customer, either in terms of giving goods on credit. And you have the competition. I think I mentioned this already. Okay, the risk of the bad debts. Okay, if as a company, by the time of making sale, you knew that this customer would be a bad debtor, would you make a sale? Of course, no. Okay, so you have to quantify the risk that the sale you have made on credit may end up becoming a bad debt. Okay, if the risk is high, then you may want to avoid or reduce, okay, making sales to those customers whose chance of becoming bad debt is very high. Okay? Because you want to avoid all the chaos that comes with a customer becoming a bad debt. Okay, so because you may want to involve the courts. Okay, if the amount of sale you made to them is quite substantial, so there's something else you may want to avoid. Okay, so the risk also be therefore might end up influencing the whether to make a sale or not. Okay, of course, financing costs. I think you mentioned this already. Don't forget, working capital. Someone else must finance you. Someone else must either through shareholders or through the bank, but someone else must be financing working capital. Okay, so if they're requiring a very high return, then why would you want to extend your goods on credit to them, to the customers on credit, whereas they don't forget you don't charge them any interest. Okay, you don't charge them any interest. Okay, so you have to be a bit careful in that sense. Okay, that if the bank is charging you, let's say 20%, which is quite high on working capital. Okay, don't forget every good you accept to the customer on credit. Okay, there's zero return to be earned. Okay, in terms of financing costs, you don't charge them any interest. Okay, because they have bought from you goods on credit. Okay, so the higher the financing cost, okay, the higher the chance that you're going to be avoiding making sales on credit. Okay, a factor you may consider is the admin cost. Okay, the admin cost. Okay, how much what's the cost of administering? Okay, what's the cost of controlling? Okay, the credit. Okay. If the cost is high, okay, then of course you may want to reduce. Okay, for example, making goods or selling goods on credit. Okay, if for example the cost you'll be incurring to finance to manage, okay, the account receivable department is quite high. Okay, for example, the employees. Okay, don't forget, every company will be having if they do sell on credit, they'll be having employees where they employ for debt collection, for example. Okay, the debt collection department. Okay, if the cost is quite high, okay, of having a debt collection, then you may want to avoid altogether. If you can make the same profit, okay, as I think I already mentioned, okay, why do you want to go to all this great length, okay, of trying to even have debt collectors all over? Okay, so company, you have to consider what's the cost of controlling the credit. Okay, okay. Don't forget, by the way, be asked these points. Okay, I think we just go through some examples from the past where the examiner, okay, was actually asked this question. Okay, what factors influence the amount of account receivable investment? Okay, the company do make. Okay, so you have to be okay. I hope the points are very clear because it's a discussion point. Are they clear, by the way? These points. And this is
Yeah.
just an example. There are more points, by the way. There are more points. This is just an example just given. Yes, sure. There's a point. There's a question.
Yeah. Could you please repeat demand for products?
Sorry, which point?
The first one.
Demand for the product. Okay.
Yeah.
If the company, as I mentioned, that if a company in code is assured of the market, okay, if there's an assurity that hey, this market is for taking, okay, is for us to take, okay, then quite unlikely the company will be offering goods on credit, okay, because whether the market want it or they don't want it, they have to buy that commodity, okay. I was trying to give an example of, for example, KPOC, okay. We are the main supplier of electricity in Kenya, okay. So if that's your case, that you are the main supplier, you're like a monopoly. Let's use that term, okay? Then you do end up having a case where you're going to have a case where you don't sell to the customer on credit, okay? You only sell to the customers on cash. Don't forget the rationale behind you selling on credit is because you want to make sales. Don't forget, okay? That's why you sell on credit because you want to make sales, okay? But in case you are sure that hey, whether the customer counts, whether we offer them credit or we offer them cash, they will have to buy from us. In that case, therefore, the company most of the time they'll be selling on cash, okay? Because the market is assured, because the market is demanding of whatever they're producing, okay? So they don't sell on credit, okay? Therefore, they sell purely on cash instead. If we have now the company coming in here, okay, where now the demand is not assured, okay, whereas there's no assurity, okay, of you having a market niche, okay, if that's the case, therefore, then you may have to entice your customers, okay, for example, give them discounts, okay, because you want to have a case, you want to ensure you can be able to make sales, okay, that's what you do, therefore offer goes on credit, you offer to them a sales on credit, okay. If it is the other way around, where the demand is there already, okay, then you don't sell on credit, you sell on cash, okay. Anyway, I hope that's clear.
Yes, it is. Thank you.
Okay, great. Now, when it comes therefore to setting up the policy, okay, there's some things that your policy on the bare minimum, okay, that your policy ought to be having, okay, your policy statement, okay, let me use that term, okay, your policy statement you have with your customer, what called credit policy statement, okay, should be having, okay. One of them is the credit period. Now, what does that mean? It means therefore is that you need to have in sort of in black and white in writing, okay, that the amount of the number of days, okay, we give a customer, well, a simple thing, okay. You as a company, do you sell on cash or do you sell on credit? Okay, and so most of or some places you may visit that here we don't deal on credit. Okay, they still say that. Okay, our sales here are purely on cash system. That's the company policy. Okay, with regard to credit extension. Or in case you, for example, you do give credit, okay, now how many days therefore do you give? The 10 days, 30, 40, how many days do you give to your customer? Okay, maybe if a customer was to come and ask for extra days, okay, generally we give 10 days. But if a customer was to ask for more days, okay, what would be the preconditions that they must achieve first before, for example, we increase the days from 10 to 30 or 10 to 40, okay, as per the customer's wish, okay. So you may want to consider what are therefore the criteria, okay, we do have, for example, before you issue the extra days, and that's what the credit standards. Okay, so I've tried to combine those two points together. Okay, that's before, for example, we do make sales to a customer on credit. Okay, there are things that as a company, the customer must achieve first. Okay, you can't just walk to the bank and ask for a loan. The bank is not going to give you. They're going to ask for a number of things. Okay, provide for us your guarantors, for example. Okay, provide for us your bank statement for the last 3 months. Okay, provide for us your payroll slip. Okay, for the last X months. Okay, if your company, give us your last 3 financial statements for the last 3 years. Okay, so that's called the bare minimum. Okay, what called the credit standard. Before we can extend any credit to you, okay, what are some of the conditions that must be achieved first? Okay, they call the credit standards here. Okay, the next is of course a discount. Okay, we as a company, do we give discount in the first place? Okay, do we give discount to our customers in the first place? And if you do give discount to a customer, okay, what must the customer achieve first before you can give this discount? Okay, what must the customer achieve first before you can decide to extend any of the discounts? Okay, and the discount you give, is it based on the number of days or is it based on the quantity? Okay, like we did in the case of the inventory. Okay, where the supplier was given discount on quantity or discount on the days. Okay, so you have to define these terms quite well and quite clear. Okay, even for your sales agent. Okay, As they attempt to make sales to customer, they must refer back to, in quote, the policy manual, okay? That say, this customer discount, how much? 2% discount. However, for them to get the 2% discount, they must have achieved A, B, C, and D, okay? So you need to have it in writing, okay? Even to ensure that the company has, or the different sales agents, okay, they apply the company policy in a consistent manner, okay, in a very consistent manner throughout their trading, throughout their sales. Okay, those are the three terms, okay. We also have another term on the debt collection, okay. Now the debt collection, now we have made the sales on credit, okay. And now how do you ensure if a sale, for example, becomes overdue, okay? The agreement you had with the customer is meant to pay in 30 days time, okay, at the end of this month, for example, okay. And now the month has elapsed, okay, the time that you agreed upon, you're meant to pay is now over, okay. Then the agreement is they pay in the 30, now it's the 35. What do we do as a company to ensure that we get this money? Because don't forget, the longer it takes the customer, the longer it takes for them to pay you money, okay, the longer the chance that that sales might become a bad debt, okay, an expense to the company, okay. So you have to be quite careful, okay, when it comes therefore to credit extension. You must have policies on how you're going to be collecting the overdues, okay. You must have a clear policy on how that's will have to happen, okay. Now, don't forget, the best way actually is before that happens, before the account goes overdue, okay? So put policies. For example, remind the customer, hey, your account is due in 2 days' time. Your account is due in 3 days' time, okay? So reminders, SMS, okay, whatever, letter, emails, okay? Because you don't want the customer to come on overdue, okay? Unless you are Shylock, okay? But I know that you're Shylock. But either way, you don't want your customer comes overdue. So what do? You need to put structures in place that will ensure the customer doesn't come overdue. Okay. If the account is very close and you can see this customer now is due by let's say 10 days. Okay, call a customer. You may want to call the customer. Get to know, okay, why is your account overdue? Okay. What can we do to help you out? Okay. This is like the case of the bank, okay. Unless most banks, okay, those ones that have good customer relation, okay, they call the customer, hey, your account is due, you're not be paying the interest, okay. So they call you, hey, we would want to sit down, okay, try to see how can we help you out, okay. Can we renegotiate the terms and condition, okay. Do we give you a debt moratorium, okay, so that you don't pay for the next 3 months, okay. Maybe your business is suffering right now, okay. So all these are some things that you may want to consider as a company when dealing or when doing credit extension, okay. Okay, and that's on the component. And actually, this is a question you examine. I think we shall go through the question back. Okay, you examine asking you discuss the component of the account receivable credit policy. Okay, so this is a question that the examiner has tested a number of times in the past. Okay, all the from the factor that influence the amount you are investing, as well as the factor that influence of the component of the credit policy. Okay, so it's good to take note of, okay, because they are being tested in the past. Any question so far? Okay, no question.